Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. I'm so glad you joined us for this podcast episode. We have a life insurance expert. Now, annuities are issued by life insurance companies, but life insurance and annuities are two separate strategies. I do not sell life insurance. I have a ton of life insurance on myself, but pretty much the top person in the life insurance industry, and he's been a thought leader for decades. He's been in the business for over 40 years. He's a personal friend. We've spoken at events together. We've spoken, at the same time. We presented life insurance and annuities at the same time. I trust him, period, for all things life insurance. A little bit about him. He's 6'8" tall. I'm 6'6", but so when we speak, it's a pretty interesting view. We look like a tag team wrestling match. He resides in Winter Park, Florida. He's a triathlete. Winter Park, Florida is a little bit is the nicer part of Orlando. Let's just put it like that. But boy, does he have some credentials. I was talking to him recently, and I said, he's been, and I'm going to look down and read it. Core to the table, top of the table, all of that stuff that's unbelievable to qualify for. He did that 20 years in a row and just stopped applying for it because he'd done it so many times, and there's so many plaques on his wall, he didn't have enough space for it. But his name is Bill Black, and he is going to be and is our life insurance expert. And I want to welcome him to Fun with Annuities. Bill, welcome to the podcast.
Stan, thank you so much for having me today. I appreciate this. Good to be with you.
Absolutely. So let's just jump right in. Bill, just give everyone an overview of the life insurance industry today, and factoring in COVID and all that. What's happening? What are you seeing? Is it what's happening in that life insurance space?
Well, what's really affecting the life insurance, of course, we always have to pass a physical exam, and with a 99% survival rate on the COVID issues, absent any comorbidities, heart issues, diabetes, which are, the mitigating factors with COVID, somebody probably wouldn't have passed the physical with that anyway. So the COVID really, what we've seen is it's doing more to keep the examiners from getting to the people to get the examinations done more than anything else. I'll tell you what's really affecting the life insurance industry today, zero interest rates.
Gotcha.
And that's had a significant effect on the market. There are actually insurance companies that have gotten out of the life insurance business because of the zero interest rates. And that presents a whole different set of challenges and the different type of policies that are available as a result of that.
Let's go deeper into the zero interest rate effect into life insurance policy, because obviously in the annuity world, when there's many types of annuities. I always tell people, if you hate all annuities, then you hate your Social Security, because that's an annuity. But there's lifetime income streams. That's the monopoly that annuities have, is providing an income stream you can never outlive, and that pricing is primarily based on your life expectancy at the time of the time you take the payments. Interest rates play a secondary role, but there are annuities that are 100% subject to interest rates, which is like multi-year guarantee annuities, fixed rate annuities. In the life insurance world, explain how interest rates affect policies.
Okay, so let's say that, take a rudimentary example. Let's say that you want $1 million policy. And let's say that your life expectancy is 20 years. Earning zero interest, what are you going to do? Well, you got to put away $50,000 a year every year for the next 20 years, because if the insurance company can't earn anything on the money, then there's no discount, so to speak. Plus, adding back in their overhead for their cost of doing the examination, their office space, their employees, etc. So it becomes kind of like, how do we make this financially viable for all of our clients. And so one of the things I look at is what is the internal rate of return on the policy. Just to give you an example, I'm working with a client yesterday who's 70 years of age.
Mm-hmm.
He has a term insurance policy, and that term insurance policy is almost over, but it is what is called convertible to permanent insurance. So what convertible means is you have a term insurance policy, the premium is level for a number of years. What happens at the end of the level period? Man, that
Right.
premium is going to get pricey. And so what you can do is you can say, thank you, I don't want this term insurance anymore, Mr. Insurance Company, give me a permanent policy. The part that's good about that is they will issue that new policy without any evidence of insurability, number one, and issue it at the health status you were when you bought the term policy. So he was super preferred non-tobacco user. If he today had had multiple heart attacks, stents, diabetes, I'm just thinking of any crazy out there on the,
Sure.
they still would have reissued, they still will reissue that new policy, that converted policy at the super preferred non-tobacco rates. So my point being that most of the time you want term insurance because you just want the coverage and the protection, right?
Right.
And so one day maybe you say, well, I really do need this insurance permanently, or I'm uninsurable now, I need some type of protection, you get to convert it. So the question, of course, becomes, what's my premium going to be? If it's
Right.
permanent insurance, it's going to be pretty expensive. And then, of course, the natural question is, well, I can probably take those premium dollars and invest it and have it grow to the same amount as the survivor's benefit.
Mm-hmm.
And so what I do is I look at what's called the internal rate of return. What would you have to earn on that premium stream to have it grow to an amount equal to the survivor's benefit? And
It's an apples to apples comparison for sure.
Yeah, you can open up an Excel spreadsheet and just run the numbers. And what that IRR means at any particular point in time, or any like 5 years from now, 10 years, whatever point in time you're looking at, what would you have to earn to have that premium stream grow to the survivor's benefit? And you can Excel spreadsheet it. If this client lives to 90 years of age in this particular conversion option, he would have to make 8% per year every year after taxes to have have that premium stream grow to the survivor's benefit. Now tell me the day you're going to die,
Yeah.
and I'll tell you the day you're going. But life expectancy is 87 years of age, right?
Got
so
it.
because he's not tobacco excellent today, I pushed it out to 90. If you could promise a client, and that's a guaranteed return, if you could promise a client an 8% after-tax rate of return for the next 20 years,
they'd build a statue of you on Wall Street. I mean,
right.
That's crazy. And I was just thinking as you were laying that out so simplistically to everyone, and it's so easy to understand. Obviously, if you have a term policy that's coming up, you need to contact Bill, and his information will be on our site. But I quote Bill all the time. He said something a long time ago, and I've known Bill for a long time. One of the first things he ever told me is, Stan, one out of one of us is going to die. And I have quoted him on that so many times. But I actually followed up with that, and I have another one that I've always said, which is life insurance is the best return on investment you will never see because you're dead. And Bill just gave that example, and it's a contractual example. It's a transfer of risk, just like annuities are a transfer of risk. So interest rates obviously would increase the ROI.
Yeah, so the more the insurance company can earn on your premium dollars, the less they have to charge you, right? So, for example, if you're going to earn 10% a year on the investment return, so part of their ultimate amount that they have to pay out is coming from earnings, they can charge you less for that premium. And we saw that for years and years. For example, in the 70s, you were paying less for term insurance in the 60s, and in the 80s, less in the 70s. And why? Well, not only interest rates, but also mortality, because as we live longer, they collect premiums for a longer period of time. So there's another, what's called actuarial gain there. So these two things fit together. Now, because life insurance is a shifting of the risk, and what are we talking about? Well, if you drive, let's say, a $50,000 car, $30,000 car, whatever it is, right? if you don't insure your car and you wreck, you got to pay that whole thing out of pocket. So
Right.
by buying car insurance, you hope you're not going to have an accident, but why are you only paying a fraction of the price? Because when everybody throws that money into one pool and they pay out the people that, right, it's sharing the risk, right? So
Mm-hmm.
that's what insurance is. It's really assigning the risk to somebody else. And the thing that people say to me every now and then is, I'm betting I'm going to die and they're betting I'm going to live. And that's not it at all with life insurance. Life insurance is we're all going to die. And many people say, look, I got a lot of money. I'm worth 10, 15, 20 million dollars. I get that. But there's two problems with that. One is often those assets are not liquid. And number two, the IRS wants 40% of it. And so the life insurance is really liquidity. It allows us to have liquid assets uh, to settle debt, to provide for beneficiaries, to provide for charities. A
Sure.
lot of times, and I'm getting off point, but a lot of times you'll see at these universities, somebody's got a building or a wing or a stadium in their name. Often that was paid for with life insurance. And if you think about it, maybe a 10, 15, 20, $30 million stadium was built, or that's probably cheap, right?
Yeah.
Um, but for 10 cents on the dollar with life insurance, and you get to deduct the premium if it's charitable. So there's all sorts of neat little things.
And
Uh,
remind people that when if you're the beneficiary of your life insurance policy, that lump sum is coming to you. Let you fill in the blank.
Income tax free and judgment creditor proof, right?
Hello.
So yeah,
Yes.
so if the insured had debts of whatever volume, it doesn't matter.
Right.
Those survivors' benefits go to the surviving beneficiary, income tax free, because the proceeds of life insurance are income tax free and protected from the claim of judgment creditors in virtually all jurisdictions, certainly in Florida and many other jurisdictions. So there's a lot of benefit to that.
And Bill is I mean, he's national like I am. I mean, he's not regional, he's national. So regardless of where you're living, touch base with him. Actually, his website, which I'm going to put on mine so you can get to it. But if you're dying to get to him right now, it's WHBCO.com. WHB as in boy, CO.com. That's how you get to Bill Black. Bill, let's go through just some basic, the types of life insurance, whether it's term, it's whole life, it's index universal. Can you
Right.
do a brief 30,000, easy to understand life insurance types for people out there that are listening to us?
Sure. So there's two basic types, term and permanent, right? So term insurance we're all familiar with. You have a very thin, small premium. You're renting your insurance, right? So back in the old days, and I mean way back, they had something called ART or ART, or annual renewable term.
Okay.
And the premium started off real cheap, and then in year 2 it went up, and in year 3 it went up, and year 4 it went up, and every year it went up. Now, why does it go up? Well, because every year we're a year older and we're a year closer to the end of the line, right?
That's right.
And then every year it was like, oh gosh, it went up again. So what they did was they, being the insurance industry, came out with what is called level premium term insurance. And you can buy a term insurance policy that has a level premium for 10 years, 15 years, 20 years, or 30 years. Now, how can they make it level? Well, they charge a little bit more in the first couple of years, and they charge a little bit less in so it's just a flat premium. And that's really the best, in my mind, type of insurance. And surprisingly, you probably don't want to buy 5-year level term. And people go, well, why not? Well, because it's almost the same price as 10-year level term, shockingly, if you price it out. So it's like, why pay for 5 when you can pay the same thing and get a level for 10, right? And so, you've got those premiums that are level for 10, 15, 20, 30 years. Why do you buy term and temporary insurance? Man, lots of reasons. First of all, it keeps your premium down. And what do we really want? We want it for protection. It's not an investment. I'm going to be the first guy to say it's not an investment.
It's a non-correlated asset.
It is, but it's liquidity. That's really what it is.
Correct.
And so a lot of clients say, listen, the reason I need term insurance is because I'm a developer. I'm building this big project. And the bank says, listen, we'll loan you the $100 million or whatever it is, right? Or somebody's got a mortgage for $1 million or $2 million or whatever. I just need the insurance in case I die. The bank wants their money back. That's a temporary need. You're going to buy term insurance. My kids are going to be out of school. Um, they're 3 now. They'll be out when they're 21, 22. I really need the liquidity for that. All sorts of temporary reasons, right?
Hmm.
Now, when you get a permanent need for insurance, what are you going to use? Well, most people think whole life. I pay a premium every year until I'm 100, and at age 100, the face value equals the cash value.
Right.
What's wrong with that? You're paying too much in premium, right? And here's the reason I don't like cash value. Let's say you've got $1 million policy
Hmm.
and a $300,000 cash value. You pass away, they're going to pay you $1 million. Well, where's my $300,000 cash value? I know what I'm going to do. I'm going to beat the system. I'm going to borrow that $300,000 out. And then when I die, my wife's going to get $1 million. Uh-oh, sorry, Charlie. Here's $1 million survivor's benefit. You borrowed $300,000 from us in a policy loan. Your beneficiary gets the net of $700,000. So then I got to throw it back to you and say, what good is your cash value? You know what? Keep your cash value. Give me the thinnest, smallest premium possible to guarantee the death benefit till I'm
Right.
100 or 110. And you know where my cash value is going to be? It's going to be on my balance sheet in premium savings in stocks or bonds or mutual funds or annuities, right? And so when I pass away, my survivor is going to get not only the survivor benefit, but these excess assets I've got on my balance sheet for my premium savings. Because all I want is the survivor's benefit. So how are we going to get this permanent insurance? They've got something called universal life. They've got something called uh, indexed universal life,
Hmm.
et cetera. So when you have universal life, it's a lot like buying term and investing. The difference, you
Hmm.
pay a premium, it goes into the cash value of the policy. They take away what we call COI, the cost of insurance,
Hmm.
and the balance is earning interest. And so as time goes by, uh, some of these policies have guaranteed premiums that they for this particular premium at your particular age and health status, you pay this premium every year till your age 100. The death benefit, the survivor's benefit is guaranteed.
Right.
That is a type of policy that is fast disappearing because of the zero interest rates. So the other thing that they've gravitated to, they being the insurance companies, is what's called indexed life. So how does that
Right.
work? You pay a premium, it goes into the cash value, they take away the cost of the insurance. The balance of it goes into the Standard and Poor's typically. That's your
An
probably
index call
go-to option.
option, like a call
Yeah,
option, right? Yeah,
right.
just like an indexed annuity. Right.
Exactly what it is. So if the Standard and Poor's in this example, if the index goes down, your option expires without value. There's no loss to you, but there's no gain either. If the market goes up, that option is exercised at a profit, and part or all of that gain is allocated to your policy. And so that's really kind of where things are going. Is there's a little bit of the risk is being shifted back to the insured in that type of an index option. So what you've got to do is ask yourself, what are the guarantees in this policy?
That's
That's the
and,
thing you
and
got
you
to look
taught
at.
me that a long time ago. One of the other things that Bill drove into me in my head, as we were traveling and speaking to the large events, the financial shows and things like that,
Mhm.
is buy the most death benefit you can for the least amount of money.
Right.
And that's a basic basic thought, and I totally believe that. Now, once we get
Mhm.
into the index universal life and those type of policies, that's where the hopes and dreams are. And as the
Mhm.
fun with annuities saying is live in the reality, not the dream. And I also say you own an annuity for what it will do, not what it might do. Same thing with life insurance. You own it
Mhm.
for what it will do, not what it might do.
Yes.
But the sales pitch, unicorns chasing the butterflies, all of the planets aligning themselves
Mhm.
are now rolling into these index universal life policies where I have seen some of the assumptions so high that you'd be the world class money manager if you ever got that, or back tested returns, which in some states are illegal to show, and I hope it becomes illegal because you can juice those numbers. Which leads me to, I really want your comment on this because this one drives me crazy, Bill.
Mhm.
And because you're the life insurance expert, I need you to just slice this up factually and put this one to bed once and for all. Got a call the other day and the guy said, well, I'm considering index universal life or et
Mhm.
cetera with a cash value so I can get tax-free income.
Oh,
Now,
sure.
now,
Mhm.
that's a neat sales pitch, but
Mhm.
the IRS hasn't approved that. When you take money out of a bank, and you get a loan from a bank, that's not income. When you take money out of a life insurance policy, if I'm not mistaken, Bill, That's a loan. That's not income. Am I right about that?
Yeah, that's why it's tax-free, because it's a loan. So go
It's
to
a
the bank
loan.
today. Go to the bank today and borrow $1 million. Loan your son or daughter some money today. Nobody's paying tax on those loans. That's
That's
why
not
it's
income. But
tax-free.
when agents and advisors semantically and play these word games saying tax-free income,
Hmm.
the trusting public is saying, well, that sounds good,
Yeah,
Martha. That's
sure.
fantastic. I love
Hmm.
tax-free income. I don't want to pay taxes. It's a loan.
Well, here's a couple of things that are going on. First of all, it's semantics, number one.
Mm-hmm.
Number two, it is true to a degree. That's the important part. It is true to a degree. It
They're
is not.
nibbling around the edges, though, Bill. You know that.
Right. No, 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 no. Let me explain what's going on. So I see some things that they're all right, and I see some things that you just want to scream. I'll give you an example of one I saw the other day. I get a lot of referrals from CPAs, okay?
Sure.
And so he said, Bill, look at this client's analysis. He was going to pay a premium for 10 years. 2 years later, he was going to borrow or withdraw 90% of what he paid into the policy back as what's called a withdrawal. That's not taxable because it's your cost basis. Then he was going to wait another 5 years and take out of that policy uh, something like 15% of the cash value every year for the next 30 years. And I went over that with a CPA and I said, this is mathematically impossible. And the CPA looked at it and he goes, where do these numbers even? And I said, yeah, it's all smoke and mirrors, right?
Absolutely.
So beyond what you're saying, some of these illustrations just aren't even mathematically possible. But here's what's going on. Listen, pay these premiums into these policies. That's after-tax money.
Mm-hmm.
It's going to go into these policies, and the index is going to return all these wonderful rates of return. Because
That
look
aren't
at what.
guaranteed. None of that's guaranteed.
Well, if the index goes up, you're going to get credit, and if the index goes down, you're
Right.
not going to lose anything. So, the market did 18% last year, and I'm only projecting 7% for you. So,
Oh my
you're going to do really
gosh.
good.
Oh my gosh.
Now, let's ignore the fact that the market fell 40% in '08, and let's ignore the fact that okay, we're going to ignore that
Yeah.
reality.
Yeah.
Okay,
Exactly.
now you get X years down the road, and you've got all these wonderful policy values. And you're going to take tax-free income from the
Mm-hmm.
policy. Now, why is it tax-free?
Yeah.
Well, because in the early years, you're not taking a loan, you're taking a withdrawal. And the reason it's a withdrawal is because that's considered a return of your principal. So that's not
Right.
taxable. So once you withdraw down to your principal, now you start taking loans, because if you don't take loans and you take withdrawals, and now you're getting into the gain of the policy. And if it wasn't a loan, that would be taxable. Okay, sounds good. So I'm going
Right.
to take a loan from this policy. Hey, what's not to like? Okay. Well, sorry, but because it's a loan, there's interest on that loan.
Correct.
And you either pay the loan interest in cash, which nobody wants to do, or if that's okay, you know what? Don't pay that interest back. We'll just take the interest out of the policy value. So now what happens is not only do you have the amount that you borrowed, but it's increasing by the interest that you're not paying out of pocket. So that doesn't sound like a big deal. Let's say that the interest is, let's be easy and say it's 3%. Okay,
Okay.
you borrow $100,000 in year one. Yeah, what the heck, right? It's 103. My loan's 103 with interest. What's the big deal? It's only $3,000. It's not a big deal until you add the second year's 100,000 on it, and the third
Mm-hmm.
year's 100,000, and the fourth
Mm-hmm.
year. Now all of a sudden, and keep in mind, interest, it's compounded, not simple. So by the time you've taken 10 loans out of the policy, now that's $30,000 plus the interest on the interest that you haven't been paid. Now what happens? Oh, wait a minute. Weren't we talking about the market fell, so your gains or your credits on your cash value growth isn't what you anticipated? Aren't we talking about interest rates have been falling lately? So all those original projections from 20 years ago that the interest alone was going to be 6 rate. Oh, wait a minute. Every year there's a cost of insurance they take away from that policy. And
Mm-hmm.
you mean to tell me that the board of directors can increase that cost of insurance at will? And they do? So how do you think when a policy that you bought 20 years ago had a minimum guaranteed rate of 5% on the cash value, and they can't get 5% on their investment portfolio, Oh, yeah, I know how we can fix that. We'll increase the cost of insurance on this class of policies. Ooh, now not only are you're paying interest on your loans, but now you got higher costs coming out, so your cash value is decreasing at an increasing rate. Okay, so some people say, yeah, yeah, yeah. So listen, I thought I was going to take that loan out for 10 years or 15 years, but because of all the stuff you're telling me, I'll only take it out for 8 years. Well, wait a minute. What happens is when you quit taking that loan out, that loan's balance still exists and they still are charging you interest. And if you don't pay the interest and that policy, what I call cannibalizes itself,
Right.
then what happens is the policy collapses of its own weight, for lack of a better explanation.
Mm-hmm.
And there's something called a forgiven loan, because when that policy lapses without value, the loan you've borrowed, you don't have to pay it back. They forgive it. Yeah, you took a policy out, all that money. There's no more money left to support the policy, so the policy lapses. You don't have to pay us back. That's okay. But they give you a 1099 because it's a forgiven loan. And a forgiven loan is taxable as ordinary income. So
Wow.
if you've got $1 million that you've borrowed out of that policy over the last 10 years, accumulated interest on top of it and everything else, this year you've got $1 million of phantom income that is subject to income tax. Now, what state do you live in? Well, if you live in Florida, okay, it's only 37%. Because let me guess, let's both agree that if you got $1 million loan that's forgiven that you get a 1099 for, it's probably going to throw you into the maximum tax bracket. I think we can
Sure.
both agree on that.
Absolutely.
Now, what if you live in another state like California, like New York, or other high tax state? That costs you $500,000. Ouch,
Wow.
right? Ouch.
Wow.
So I had a client that said, Bill, my son-in-law is being shown these wonderful, and you know, if you look at it, the income that's coming off those projections is like sky high as a
Income
rate
in
of return.
quotation marks.
Right,
You
right,
know,
right, right.
right.
The yes. And so I mean, the first thing I did was I looked at the projected values and I said, right, but look at what's guaranteed. And after he took out the first loan, income, whatever you want to call it, the
Sure.
guarantees went to zero. So, you know, it's like you and I are both saying, this is you know, if you go into any business situation, what are you looking at? What's the best I can do? What's the worst I can do? If you can live with the worst, then it's okay. Uh,
Right.
right? And if the worst you're going to do in a policy like this is take the first quote income out and the
Mhm.
policy collapses, probably not a good deal.
Well, and it just all comes back to if it sounds too good to be true or looks too good to be true, it is every single time, and you're not focusing on the contractual guarantees, you're focusing on the pie in the sky numbers that the agent or advisor wants you to do that. And the other thing, this we're not going to mention any names or any type of marketing that's going on
Hmm.
because we're just not. But what's happening in the industry showing people a quote unquote tax-free income. This has been around, Bill, you and I both know for 30 years. They just keep putting lipstick on the pig and selling hopes and dreams, and the stories, you know, get better and sexier, etc. Um, I got a call the other day, which is one of the most disturbing life insurance calls I've ever received.
Hmm.
This person was being advised to cash in their IRA,
Hmm.
pay the penalty, and then
Hmm.
front end load a life insurance policy,
Hmm.
which I want you to not only talk about that, but talk about the phrase modified endowment contract and the reason people need to understand what that is. Can you cover both this ridiculous and people every day you know, are cashing in their IRAs to buy life insurance policies? Cover that and cover the MEC modified endowment contract,
Yeah.
if you
Well, first of all, now you're starting to irritate me, right? Because when people
could.
say this, these are the type of people that are advising that don't understand taxation.
Right,
They don't understand what's called present value and future value, right?
right.
And the growth trajectory. So
Mhm.
let's talk first of all about cashing our IRA in. Now, your
Ugh.
IRA, when you cash it in, is taxable as ordinary income. And if you're under 59 and a half, you're going to pay a 10% penalty in addition to the taxation, right?
Right.
So let's just say, for sake of conversation, let's just say that's 35%. The 10% and a 25. We'll be generous and say it's a
Sure.
25% federal tax bracket and a 10% excise tax. You're paying
Mm-hmm.
35%. We'll forget state income taxes and everything else. If the market fell by 35% today, you would be shell shocked, right?
Oh
You would
yeah.
you would just be
Oh
sitting
yeah.
here going, wait a minute. But somehow we're being advised to let the tax authorities take 35% of our money, and that's okay. Yeah. Now, secondly, when you take that money and you reinvest it in some alternate investment, you got a hole you got to dig yourself out of, right? You got to earn, 50% on your money, right? You only got 65% left. You got to
Sure.
earn 30,000, 35,000, or 50% of what you got left to get back to even. Okay, wait a minute. There's an ugly reality here. This is why I say life insurance is protection. When you buy life insurance, if you bought a mutual fund today, just the average listener today is not going to want to buy what's called a retail A share. That means you're going to pay 5.5% off the top
Mm-hmm.
to sales loads. So you've got 95 cents on the dollar working for you.
Right.
Okay. That's not really a great, right? But somehow I'm supposed to let 35% of the value of my IRA go in taxes and then buy a life insurance policy that has front loads like premium tax in some states
Sure.
and other loads. So now the insurance company and the tax authorities are going to take 5 to 10% of what I pay into that policy. Now I'm going to have a surrender charge on that policy if I want my money back. I'll be lucky if I'm getting 40 cents on the dollar or
Sure.
even 35 cents on the dollar. And now I'm going to wait all of this time and then start taking income out that isn't even guaranteed.
And
Or if I just,
it's not even income.
well, yeah,
I mean, it's a
that's
loan.
right, right. It's flow is of some type. And if
Exactly.
we just took that IRA, left it where it was,
Mm-hmm.
projected it forward at a 3% rate of return, maybe even 2%, right? And then looked at the income we were going to take out of that compared to this wonderful recommendation, client's not going to be any better off. And now what you're doing is you're taking a leap of faith,
Sure.
and I hate to say it, but probably going to be severely disappointed.
Explain a modified endowment contract.
So what happens is back when interest rates were at 16, 18%, remember when you could
Jimmy
buy a
Carter.
CD?
Jimmy
Yeah.
Carter. Yeah.
Go get a CD for 16%, 18%. It was like, wow, right?
Yeah. Exactly.
Well, what happened back then were life insurance policies were basically paying about 3%. So what did you do? You went and borrowed your cash value at 3%, bought a CD at 18%. Back then you could deduct the interest, right? And so the insurance company said, listen, Stan, don't do that. I know what you're doing. We're taking the money that you pay us and we're investing it and getting a higher rate of return anyway. And we're going to credit this higher return to your cash value. So there's no need to go through all these machinations. Instead of you getting a 16% CD, we're crediting 16% to your cash value. So just go to these newer type of policies. Well, people are smart in certain ways, and so what happened was, and it all starts in California, they they they
Always.
they started selling this thing called single premium whole life. Listen, Stan, give me $1 million and I'll give you $1 million insurance benefit. Why would I do that? Oh, well, because life insurance grows without taxation on the cash value. You can loan or borrow that money out of the cash value without paying tax on it. And then when you pass, remember that money goes income tax free to your beneficiary and outside the reach of
Mm-hmm.
judgment creditors. And so by calling it life insurance, wrapper around it, it didn't cost you anything because if you give me $1 million, I'll insure you for $1 million. There's no risk, so I'm not charging you for the insurance,
Right.
and you're still getting the good rate of return, and you're not paying tax on it because the cash value growth, the growth in the cash value isn't taxable. You can borrow that money out, and loans aren't taxable. Everything like that. So the IRS, after a while, said, "Wait a minute, hold on. This isn't life insurance. It's not
Hmm.
insurance because there's nothing at risk."
Right.
So we're going to change the rules. And we're going to say for every dollar you have in cash value, you have to have a certain multiple of survivor's benefit. And that's called the corridor. So that corridor is shown in every policy. And so let's say at age 40, I'm just picking out numbers. For every dollar you have in cash value, you got to have $2.40 in survivor's benefit, right?
Sure. Yeah.
So if you don't have that, corridor, if you're below the corridor, so let's say in this example, you don't have $2.40 multiple, you've got $1.40 multiple. That's a modified endowment policy. So when you pass away, the survivor's benefit is still income tax free. But when you access policy values in the form of a loan or anything else, it's what's called LIFO, last in, first out. So
Mm-hmm.
now the first loan you get or withdrawal you take is considered the return of the earnings, not your principal. So it's taxable as ordinary income down until you've taken all the earnings out. And then once you're down below that, you take the money out in principal, then there's no tax on that. So it's a LIFO, but the survivor's benefit is still income tax free. So if you're buying life insurance for the survivor's benefit, MEC doesn't really matter. But if you're buying life insurance for the survivor's benefit, you're not going to have a MEC because you're not going to load it up to build up the cash value, right? So it's kind of a mutually exclusive thing. So those MECs come in these overloaded, look at all this wonderful cash value type of a
Right.
projection.
And yeah, and people just have to be careful about that.
Mhm.
Once again, you can contact Bill. His site is WHBCO. If you have a policy, you can, he'll take a look at it and tell you the brutal and factual truth about it. And I forgot to mention earlier that he is also a specialist and nationally known for employer benefit plans.
Yeah.
And for all size companies, he's a master of that. He's been in the business 40 years, but his two lanes are that employer benefit plans, and then life insurance. I mean, and, doing it for 4 decades, he's forgotten more than anyone will ever know about life insurance. I mean, he truly, if you're just listening to his radio TV voice, he's got the best voice ever.
Oh, thank you.
But I mean, he does, but he understands life insurance backwards and forwards. And I think the key thing here, Bill, is you can get through the sales pitch. You can get through the proposal and the juice numbers. For consumers out there and the people that are listening to this on all the podcast platforms with Fun with Annuities, and also my YouTube channel, the Fun with Annuities YouTube channel, what would you tell the consumer to watch out for in the sales pitch world of life insurance?
Well, when you're buying life insurance for a reason other than the life insurance, when it's being positioned as an investment, there are some times when that does have merit, but often not, right? And so the first thing you want to look at is why is it not just for the protection? And that's the first thing I would be wary of, if I may. Yeah.
Well, and we had we did a podcast recently with Jack Lindenberg, who's he's the top long-term care specialist, and there's such things called asset-based long-term care that uses
Yeah.
life insurance as a delivery system for that benefit.
Right.
But once again, you're not buying it for the life insurance death benefit. You're buying it for the long-term care. So there are certain situations, but is it fair to say, and I always say this in the annuity industry, if it sounds too good to be true, it is. Is it fair to say that in the life insurance side as well?
Well, I'll tell you what, the life insurance policies that have a long-term care rider are fantastic. And let me explain why. You buy a long-term care policy today, just a flat-out long-term care policy. If you never use it, you just spend all that money, number one.
Goes down the rabbit hole. Absolutely. Yeah.
But these long-term care policies, see, the thing about life insurance is we're all going to die, and mortality is pretty, believe it or not, exact. At the beginning of a year, an insurance company knows what they're paying out in claims at the end of the year because mortality is what it is.
Yep.
Okay. So the thing about morbidity, which is what it's called when you have long-term care, is it's not predictable, right? How many people are going to get a heart attack this year? How many people are going to blah, blah, blah? Yeah. So what happens is those long-term care policies, and I'm sure a lot of listeners know this, the carrier can come back and say, Stan, we got to raise our rates this year, or we're going to lower your benefits. How do you get around that? You buy a life insurance policy with a long-term care benefit hooked onto it. Mm-hmm. And here's how it works. They're going to pay you 2% of the face value of the policy for 50 months. Now, most people, I think the statistics will show, last a little over 3 years, right? Yeah. 36 months.
Correct.
So they're going to pay you 2% of the face value a month for 50 months. That's a little over 4 years. So what happens if you buy a $500,000 policy? They're going to give you $10,000 a month for long-term care benefits, and that's tax-free. And then when you pass away, there's a little calculation, right? What was the survivor's benefit of the policy originally? How much did we pay out in long-term care? The rest goes to your named beneficiary. income tax free. And that is a fixed price. There's no monkey business with it. There's no ifs, ands, or buts when you buy the right
Right.
policy that has the right guarantees on it. But then they also have something called an accelerated benefit rider. And if you've got less than 6 months to live, the typical policy, the riders are all just slightly different, but the
Mm-hmm.
general idea is if you've got 6 months left to live or less, and you get a letter from a doctor, they'll pay you out a large percentage of that survivor's benefit today, and it's tax free. Now, why do they do that? Well, mathematically, whether they pay it out 6 months early or not doesn't affect their curve, their mortality curve.
Sure.
And most people don't pass right now, right? Like a car wreck, like a sudden heart attack. They linger. What happens when you're lingering? You're running up medical bills, right?
Right.
And so by them giving you this cash now, it's really something that is public policy. It helps the family not to have that. First of all, we've all had people pass, and it's really
Sure.
rough. The last thing you want is a mountain of bills on top of it that's just more stress, right? So there are good things that come wrapped in these life insurance policies. And what we do is we look at a client's insurance policy. Like I got some on my desk today. I've got this insurance and I'm not paying anything for. I mean, I've got $1 million and I pay $600 a quarter.
Sure.
And I said yes. Now, here's the story about this client. This client has had severe health issues, and they've got other problems. Well, how long is that premium for? Oh, that's the way it is for the rest of my life. Now, it's not, right? So I looked at the policy, and it was
Exactly.
a 20-year level term premium,
Sure.
and they thought it
Yeah.
was, forever because they've had it for 18 years.
Right.
Well, I say, you know what? In 2 years, this premium's going to go through the roof, and they were just totally unaware of it, right? So while it's still convertible, you because those conversion windows close, they're not good forever, right? There's a time when that
That's right.
conversion window's closed. It's usually the end of the level period or age 65, depending
Sure.
on what comes first. Now, got other policies where another one came across my desk today. They had a 15-year term policy, 1 year left on it. What are you going
Mm-hmm.
to do at the end of next year? Rates are going to be, if you stay with this policy, be going way, way up. We
Sure.
just do a simple mathematical analysis. This is where you are now. This is where we'd recommend you go. Here's the difference in dollars. It's a sterile financial analysis, right? It's not, oh, but cash value. Oh, but I'm your nephew. Oh, I'm your golf
Right.
buddy. It's none of
Right.
that nonsense, right? It's just
Right.
dollars. It's math and taxes.
It's Matt. Hey, we got one more segment I kind of want to get to before we
Okay.
close this out, and let's talk a little bit about you mentioned to me the other day in preparation for this podcast about the settlements with life insurance.
Oh,
Can you
yeah.
can you cover that for
Sure.
people, because there's a lot of misinformation out there about
Oh,
settlements.
yeah. Yeah. Here's the situation. You got to forget for a second life insurance and think of it as an asset, right? It's an intangible asset, just like a stock certificate, right?
Sure.
So what happens to that insurance? Well, it's a lot like your boat, your car. There comes
Mm-hmm.
a time when you don't need it or want it anymore. And so you can just tell with the term insurance, you know what, I don't want this anymore. I'm just going to let it go. I'm just not going to renew the premium and goodbye. Well, another real life example, got a client that has a $750,000 term insurance policy.
Mm-hmm.
He's had a level premium for 20 years. Next year, the policy is going through the premium is going through the roof. Doesn't want the policy anymore.
Right.
Well, wait a minute. Don't just walk away from it. And now the insurance company's got all that cash. You can sell that policy just like a stock, a bond, or a mutual fund. Now, who is
Right.
buying it, right? There was a comment you made earlier about non-correlated assets.
Mm-hmm.
So hedge funds are buying these policies. Well, why? Well, you've got a diversified stock portfolio. Oh, you've got some of it in consumer goods, some of it in energy, some of it, well, you know what? When the market goes down, it's all going down. I don't care how well diversified it is. When the market goes down, all those shares are going to lose value, right? Well, okay. But a hedge fund has to return to its investors. And so what they do is they buy these life insurance policies and they pay the premium on them. And when the policy, when the insured passes away, they get the survivor's benefit. So this particular client had $1 million policy. His health had deteriorated. And what happens is you get your medical records, they calculate a life expectancy, and they make an offer on it. This particular client, they offered him $150,000 for his policy. So
That's
think about that for a minute. You're going to walk away from it, or you're going to sell it to a hedge fund, and get substantial cash. Now, yes, it's taxable as income, but if you
Sure.
had a gain on your stock certificate, it would be
Sure.
taxable as income. What you pay in premium, what you get for selling the policy, the difference is taxable as income. It's a fair deal. But rather than just walking away from a policy, I don't want my policy anymore. I got 75,000 in cash value. Just give me my.
Right.
Wait a minute. Wait. What if I could get 125 for that policy instead of just turning it in for 75,000? This is where you just and you know what? If we shop the market for a client, the offer is always going to be more than the surrender value of the policy. Otherwise, the offer is no offer, because if you can surrender it for $1, nobody's going to offer you 80 cents for it, right?
Correct.
It's just not, yeah. So what happens is the worst you're going to do by shopping the market is be in the same position you are today, right? Because
There's
you'll
just
never
no
get less.
downside.
Yeah, there's
There's
no
no
downside.
downside.
So a lot of times a client will come to us and I'll tell them right out of the gate, there's either value here or there's not. Now, why would
Right.
there not be value? If they're 60 years old, they're in great health, and they got a 40-year life expectancy, sorry, there's probably not a lot of value. But if you bought that policy and it was
Right.
super preferred non-tobacco user, and now you've had a health incident or two, or you're 75 or 80, there's probably going to be some value in that policy. And
And
so
that's
that's
it.
what a life settlement is.
And that's the reason you see all these television commercials, saying you can sell your life insurance policy.
Yes.
Bill and I obviously been around the block a long, long time, and we know people in the hedge fund world. And I had one person, they told me they call them death bonds because in essence it functions like a bond for the hedge fund. But they're getting a coupon based on life expectancy and when you die. And I think it's a very interesting market, and I think that the listeners need to understand that. Just don't let the policy lapse. Give Bill a call. He's got the best staff in the business. His staff is talented, so they can go in and see if there's some value there for you. But all of these ads that you're seeing on TV, we're not going to mention the names, and they're sell your life insurance policy and all that stuff. What they typically do is they package those settlements and then sell it to a hedge fund in a lot of cases, or the hedge funds are directly buying it and they're just the middlemen. But if you're going to have a middleman in this situation, why not someone with 40 years of experience, Bill Black? Bill, we've covered a lot today, and we're going to have you back on to go deeper in and give more examples of your clients, what you're seeing out there, and what you can do. Remember that not only is he a life insurance expert, he is an expert on employer benefit strategies, for retirement plans, etc. I mean, he knows what he's doing. Once again, his website will be on our site, but I encourage you to go there. It's of course www.whbco.com, whbco.com. His name is Bill Black. He's a dear friend of mine. We've known each other for a very, very long time. And Bill, I really appreciate you being with us. Any final comments before I close this out?
Yeah, something just came to me about life settlements. If you go to the people on TV, you're going to one person, and they're going to give you an offer that's maybe 15% above cash value, right? And you're going to think you've got a gain. What we do is we actually go to the market and shop it among what are called all the funders. There's many people, many hedge funds out there buying it. So we're going to negotiate the highest and best price for you. A lot of times when you just go to the one person on TV, whomever that may be, and they know you're not shopping it, you're not going to get the best value most often. So just something to keep in mind. In fact, I've been at the industry events just like you have, Stan, and I've had some of these guys say, oh yeah, the client will take $50,000 more than the value of the policy and think they've got a gain, and and I thought to myself, that's just not good business. But, so there's some things like that are going on behind the scenes that you want to be real careful about. And like anything else, we bid it out to everybody and to get the highest and best value. So that's where it goes.
Sounds familiar to my clients, because I always say I shop all carriers for the highest contractual guarantee.
Oh, yeah.
Bill does the same thing. I think in conclusion, my listeners have just found their life insurance agent. His name is Bill Black. And I encourage you to contact him. He is a straight shooter, and he's a true professional if there ever was one. But I appreciate everybody joining us for this episode, and I'll see everybody next week on Fun with Annuities. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 annuity owner's manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.